If you've been tracking the shifting dynamics between retail traders and institutional market structures, I have a really fascinating analysis to look at today. I just want to map out the arguments the retail community is using to push for clearer reporting standards and greater transparency in how their orders are handled. Looking at the data they're weaponizing, the sheer volume going off exchange is just wild. It's a massive amount that raises legitimate questions about market function. My analysis notes that 87.17% of AMC's 18.57 million shares were routed away from public exchanges during the examined period. And at times that spiked to nearly 89.5%, which is basically 9 out of 10 shares trading completely outside the view of public markets. In my view, the question becomes, how does a stock even function when practically 9 out of 10 shares are bypassing the market entirely? What does price discovery even mean under these conditions? Well, that is the exact structural vulnerability retail advocates are pointing out in their ongoing campaign for regulatory attention. With nearly 90% off-exchange routing, in my opinion, we aren't just looking at standard dark pool utilization for institutional block trades. It's not just institutions quietly moving big positions behind the scenes. It's a near total bypass of the lit market's primary function, which is price discovery through transparent buyer and seller interaction. When that much volume is suppressed from the public tape, the visible order book becomes incredibly fragmented and potentially misleading for anyone relying on it for trading decisions. I think the part that really grounds this analysis is the Cinemark comparison, which provides essential context for understanding whether AMC's routing patterns are industry standard or genuinely exceptional. What's fascinating here is how effectively retail investors are using that peer benchmark to build their case. Cinemark's off-exchange trading sat at just 38.86% in my findings, which represents a completely different trading profile despite operating in the exact same industry sector. They aren't just making vague complaints about fairness anymore without supporting evidence. They're presenting a direct, data-driven juxtaposition within the exact same industry that regulators and market participants cannot easily dismiss. Putting AMC's 87% right next to Cinemark's roughly 39% logically corners regulatory bodies in my assessment, because it demonstrates that a more balanced routing environment is demonstrably possible under existing market structures. This comparison makes it much harder to dismiss the inquiry as just a simple misunderstanding of market mechanics or a special pleading from inexperienced traders. Let me look at the practical impact on the ticker and what this means for ordinary investors trying to make sense of price movements. The data highlights a day where AMC traded over 26 million shares, but actually closed down 3% at $1.18, which seems counterintuitive given the volume. That volume to price action ratio is exactly what they're questioning in their analysis of market fairness. If the vast majority of that massive volume never hits the public tape in my analysis, does that volume even mean anything for the stock's actual valuation in the visible market? Isn't that distorting the basic inputs of supply and demand that traditional market theory says should determine price? It heavily skews those inputs in ways that benefit certain market participants while potentially disadvantaging others. If public buying pressure is continuously internalized or routed off exchange, it just doesn't exert upward pressure on the bid, regardless of how many shares change hands behind the scenes. So the retail argument is that the resulting $1.18 price tag can't possibly reflect actual public demand for the stock, because the mechanism designed to weigh that demand is being systematically circumvented through routing practices that prioritize internalization over price discovery, which really explains the aggressive shift in strategy from these investors in my view, moving beyond passive ownership toward active advocacy. They aren't just passively holding shares and hoping for the best anymore while trusting that markets operate fairly. They are actively organizing now across multiple platforms to amplify their concerns. I'm seeing them use this collective strength to directly tag figures on social media, people like SEC Chair Paul Atkins and AMC CEO Adam Aron, demanding responses to their questions. It's a highly targeted pressure campaign designed to force acknowledgement of issues they believe are being ignored. They're demanding accountability from the specific individuals tasked with either regulating the market or protecting shareholder value through corporate governance. They want a fair, free market that operates with transparency for all participants, regardless of their size or sophistication. Watching retail investors corner the SEC chair and a corporate CEO, in my opinion, isn't just internet noise or performative outrage without substance. Whether you trade every day or you just casually follow business news as an interested observer, this story is a real-time masterclass in how ordinary people can engage with complex financial systems. It's everyday people reverse engineering Wall Street's institutional plumbing to turn pure confusion into educated advocacy for change that benefits all market participants. We have a massive catalysts for AMC stock. And if you have been paying attention to the upcoming theatrical slate, you know exactly why the short sellers are absolutely cooked right now. The mainstream financial narrative has tried for years to convince everyone that movie theaters are fading away, but Hollywood is actively loading up the biggest and most highly anticipated slate of blockbuster films we have seen in quite some time, making this an undeniable turning point for the company. Just take a look at the massive 2026 theater lineup that is getting everyone in the retail community so hyped up. We are talking about guaranteed, multi-generational box office smash hits arriving back-to-back, including Toy Story 5, a new Super Mario movie which is currently rumored to be Super Mario Galaxy, and the next highly anticipated web-slinging chapter with Spider-Man, Brand New Day. As if that was not enough to completely fill every single seat in the house, we also have Avengers Doomsday bringing back the massive superhero crowds, the live-action Moana, The Mandalorian and Grogu jumping from streaming to the big screen, and a brand new Hunger Games movie dropping to capture that huge young adult audience. And remember, that is just a few of the massive titles on the way to drive incredible foot traffic, high-margin concession sales, and premium screen bookings. This undeniable pipeline of top-tier cinematic entertainment proves that the theatrical experience is not going anywhere anytime soon. Shorts bet heavily against the magic of movies, assuming the entire industry would just roll over, but the apes bet on the enduring power of the box office and the unmatched feeling of seeing a major cinematic event with a packed crowd. With this kind of heavy-hitting content calendar on the horizon, the fundamental business model is looking incredibly strong, setting the ultimate stage for major upward momentum and a spectacular revival. If I connect this to the bigger picture beyond just these two theater chains, this isn't isolated to a single movie ticket company in my assessment. It's really a battle over the fundamental integrity of stock valuation itself and who gets to participate in price discovery. The principles at stake apply broadly across markets and could reshape how trading works for years to come. So that leaves a massive question for you to mull over today as you consider your own market participation. If organized retail investors actually succeed in forcing these off-exchange trades into the light through regulatory pressure or rule changes, how might that sudden transparency ripple out and fundamentally alter the valuation of the broader stock market you interact with every day? What would your portfolio look like in a world where every trade contributed directly to price discovery rather than being hidden from public view?